Good evening, and welcome to the American Antiquarian Society's program with Sharon Murphy on her book Banking on Slavery, Financing Southern Expansion in the Antebellum United States. The American Antiquarian Society is located on the ancestral homelands of the Nipmuc community, who remain an active presence here in central Massachusetts. My name is Mark Peterson. I am a professor of history at Yale University, and I serve on the American Antiquarian Society's council. As a national research library, our mission at AAS is to cultivate a deeper understanding of the American past, grounded in primary sources like those in our vast pre-1900 collections. We foster a broad community of inquiry through inclusive programs and support of scholarship. We welcome researchers from far and wide to use the collections, both physical and digital, and we host programs like this one that provide insights into the past and its resonance for today. The program is being recorded, and you can watch recordings of this and all of our programs on our YouTube channel and on our website at americanantiquarian.org. We will have time for your questions later in the program. You can post them in the Q&A at the bottom of your screen at any time. And Lauren Haviles, Programs Coordinator, will be putting relevant information into the chat during the program. And please know that as a private nonprofit organization, we welcome any support you can provide to help keep our work going. And thank you. Now it's my pleasure to introduce our speaker. Sharon Ann Murphy is a professor of history at Providence College. She specializes in the financial history of the United States, with a particular interest in the complex interactions between financial institutions and their clientele. Her latest book is Banking on Slavery, Financing Southern Expansion in the Antebellum United States, published by the University of Chicago Press in 2023. And I will add that I am more than a little proud to be the co-editor of the series at the University of Chicago Press that published this wonderful book. Sharon's book examines the relationship between commercial banks and the development of the southern frontier during the first half of the 19th century. The book is the winner of the 2023 Book Prize of the Society for Historians of the Early American Republic, the 2023 Williams Prize in Louisiana History, the 2024 Bennett H. Wall Award of the Southern Historical Association, and if you thought that was all, you would be wrong, because it was also the winner of the 2024 Ralph Gomery Prize of the Business History Conference. Sharon is also the author of other books, including Investing in Life, Insurance in Antebellum America, which is from Johns Hopkins Press in 2010, and it was the winner of the 2012 Hagley Prize for the best book in business history. She also wrote Other People's Money, How Banking Worked in the Early American Republic, Johns Hopkins 2017. She's been an associate editor of Enterprise and Society, the International Journal of Business History, since 2011, and is also a past president of the Business History Conference 2023 to 2024. In other words, she's got this business history thing pretty much covered. Murphy was a National Endowment for the Humanities long-term fellow at the AAS in 2018, 2019. And so we're very happy to be welcoming Sharon virtually back to AAS. And now she will be presenting her program on this fascinating book. Sharon, it's all yours.
Great. Let me just share my screen here. Oh, and I have the wrong screen that you're seeing, don't I? Okay. Are you seeing the right screen, Mark?
Yes, I am.
Great. Okay, perfect. So, first of all, I'd like to thank Mark for that kind introduction, and Nan Wolverton for inviting me to give this talk, and for everyone here at AAS for always being so wonderful. This book, I did much of the outlining and trying to figure out what the heck this book was going to look like, the shape of the book. Much of it I did while on that fellowship at AAS. So I'm really appreciative of all the input I received while I was there. So this project did directly emerge from my last book, Other People's Money: How Banking Worked in Antebellum America, which was my attempt to teach basic financial literacy of antebellum America to a broad historical audience. And as I was writing my section on the relationship between banking and slavery, I was struck by how anemic the discussion was. This is the entirety of that section. It's two paragraphs. Was there really no substantial connection between banking and slavery? Was this really it? So when I began this project, this was not the project I was intending to do, but I felt called, I need to look into this. So I was interested in uncovering the ways that commercial banks directly, knowingly, and explicitly interacted with the slave system. And I was interested in commercial banks in both the North and the South, as well as the federally chartered first and second banks in the United States. And I wanted to concentrate on commercial banks for several reasons. First, they are the financial intermediaries that deal with the types of contracts, like mortgages backed by enslaved people and loans for the purchase of these enslaved people, which would require direct interaction with the enslaved themselves. And two, because government sanction of these activities, in the form of a state charter for the bank, matters in terms of what activities a given society deems to be acceptable. Now, in the antebellum period, commercial banks were chartered through individual acts of incorporation by each state, which granted them the privilege of issuing banknotes and defined the basic terms of lending in which they could engage. With the exception of the first and second banks of the United States, most banks primarily operated within the state they were chartered. Therefore, I quickly discovered that the direct role of northern commercial banks with the types of financing I focused on was pretty insignificant. More surprisingly, the direct relationship between commercial banks and slavery in the more established parts of the South, those states along the Atlantic seaboard like Virginia, North Carolina, Maryland, this was also much more limited than I expected. The traditional lending practices of commercial banks were not readily compatible with the needs of slaveholders. Now, the most common type of lending engaged in by commercial banks in both the North and the South was discounting, which was a specific type of short-term paper for business people engaged in trade. So a merchant, like the merchant in this discount note here, would obtain goods from a seller by issuing a promissory note, often just referred to as commercial paper. And they would promise to pay the full amount at a specific future date, in this case, 4 months after December 14th, 1848, at which point this merchant presumably would have sold the goods in question. The seller could then take this note to a bank to be discounted. The bank would loan him the face value of the note, in this case $43, less a discount reflecting the interest rate. And so, for example, a typical commercial bank charter stated, the president and directors may discount notes or bills at any length of time, not exceeding 60 days, but may renew the same from time to time at pleasure. Thus, the charter itself explicitly defined the lending terms permitted by the bank. Proponents of sound banking asserted that discounting was the safest type of loan because these loans were backed by real commodities, goods in transit, items awaiting sale, a harvest about to be shipped, and so forth. These loans were short term, usually only 30 to 60 days, and they were self-liquidating, meaning as soon as the sale was completed, the note would be repaid. In actuality, these notes were often renewed, as the charter here permits, but the bank would require the payment of an additional discount with each renewal. And at any point, the bank could decline the renewal and demand payment in full. So these features, particularly the short-term nature of the loans, were also what made these loans of little use in the agricultural sector. So most banks were chartered for urban areas and tended to serve a mercantile clientele. These features also made these banks of little direct use for the slave economy. By their nature, traditional commercial banks were conservative entities that did not provide the type of financial assistance needed by most slaveholders, namely long-term loans in larger amounts than what was permitted by most bank charters, backed by landed and enslaved property. The traditional structure of commercial banks made them of little use to the slave economy during the first 2 decades of the 19th century. However, even if these traditional commercial banks did not initially promote and directly support the slave economy, many of these banks still directly interacted with the slave system. First, if the debtor failed to repay their discount loan, the bank could sue the debtor and or any endorsers of a note in question for repayment. The court would issue an order of fieri facias, or fee-fa for short, which allowed the sheriff to seize and sell the property of the debtor or any of the endorsers in payment of the delinquent obligation. So, for example, this is a list of sheriff sales of different enslaved people. Number 4 is one Negro to be resold as the property of David Ulmer at the suit of the president, directors, and company of the state bank. So the state bank seized that particular slave in repayment of a debt and was now trying to sell it to get some cash out of this person. And it was through these fee-fa judgments that early banks first engaged directly with human property. Southern banks willingly seized and sold enslaved people as part of these foreclosure proceedings. Second, if a debtor wished to renew a discount loan, the bank could ask for additional security as collateral for the loan. In the South, banks regularly accepted enslaved people as mortgage collateral for the securitization of existing short-term loans. Thus, these traditional commercial banks were certainly interacting with the slave system, even if they were doing little to directly support or further the expansion of slavery. In the settled areas of the Atlantic seaboard, most banks would maintain this conservative focus throughout the antebellum period. But the population was rapidly expanding westward, and the average price of enslaved people soared. This discrepancy between banking practices and local demands initially started hampering the economic growth in these regions. A few banks, especially those operating on the frontier, as well as the Second Bank of the United States, began to actively push against these traditional banking limits, allowing businessmen to accumulate increasingly large debts from discounting business notes, which were repeatedly renewed, using land and enslaved individuals as collateral. The largely positive experiences of both debtors and banks with these mortgage contracts during and after the Panic of 1819 convinced frontier bankers that enslaved lives were not only acceptable, but were superior to other assets as collateral. Thus, during the 1820s and 1830s, bankers operating on the frontier were increasingly willing to initiate new, long-term loans secured by enslaved individuals, and even to finance the initial purchase of plantations and enslaved lives secured by the same property, often in defiance of the terms of their state charters. Yet the financing needs of the people pouring into Western Georgia, Alabama, Mississippi, and Louisiana greatly surpassed what these conservative banks could offer, even with their most creative interpretations of the discounting function. For the planters, large, long-term loans secured by their plantations and enslaved workers were essential for their survival and growth. State legislatures in places like Louisiana initially tried to work within the confines of traditional commercial banks to meet these needs. In 1824, the legislature chartered the Bank of Louisiana with $4 million in capital, which was half owned by the state. While the bank was permitted to discount notes for up to 4 months, twice as long as traditionally permitted, it was required to lend at least half of its capital in long-term mortgages of up to $5,000 each, payable in 5 years. The bank rules openly recognized that enslaved people were legally classified as immovable property in Louisiana and thus could be used as part of this mortgage security. And it's a long story about why they're classified as immovable, but that's for another time. The following year, the legislature revised the charter of the older Louisiana State Bank, allowing it also to issue long-term renewals of discounted loans, with the debtor paying in 4 equal installments annually, as long as the debtor secured the loan with adequate mortgage collateral. This shift to long-term property lending had a substantial effect on the credit options of planters in Louisiana. Large mortgages, directly secured by land and human property, became the norm for institutions like the Bank of Louisiana. According to the charter, branch loans and discounts were limited to $5,000 per individual. In practice, however, the bank regularly approved loans of 4 to 5 times this amount. For just one typical example, in March 1830, I know you can't read this, but in March 1830, this slaveholder, William Leverich, received a $20,000 loan secured by a mortgage on his St. Charles sugar plantation and 49 enslaved workers, which he would not pay off until 8 years later. This is the document releasing him from that mortgage in 1838, which describes the original terms of the mortgage, including the property used to secure it, listing the 49 slaves by name and age. And this is pretty typical of the notarial records at the heart of my research. Although property loans at the bank were supposed to be limited to 5 years, they regularly extended well beyond that limit, as in this case, as long as the debtor continued to make at least partial annual payments and the bank deemed the debtor still to be a sound risk. But even these banking options were not adequate. Both Louisiana merchants and planters lobbied the legislature for even more banks. And so the Bank of Louisiana was joined by the Citibank of New Orleans, the Mechanics and Traders Bank, the New Orleans Canal and Banking Company, all of which were headquartered in New Orleans but had branches throughout the state. But interestingly, mostly in the cotton growing areas of the state. And so the letters there show where they have their branches. The darker the color, the more intense the sugar production. So the darker areas are the parishes with the most intense sugar production in Louisiana. So the one major constituency largely ignored in the expansion of Louisiana's commercial banks during the 1820s were the planters, and especially the sugar planters. And while both cotton and sugar planters controlled vast wealth in the form of land and human property, this wealth was not liquid. It was tied up in that property, making it difficult to charter a new planters bank on a traditional bank model. This would have required someone to have cash to buy those stock shares that would serve as the basis of the banking capital, and they didn't have that available. So rather than continuing to try to fit the system of slavery into the traditional commercial banking apparatus, Southerners began reimagining the relationship between banking and slavery. Chartering the Consolidated Association of Planters of Louisiana, the CAPL, in 1827 with $2 million of capital as a new type of plantation bank. Traditionally, commercial bank charters required a specific amount of paid-in capital from their shareholders in order to begin operations. In contrast, the charters of plantation banks modeled on the CAPL required no paid-in capital to begin operations. The reserves of the bank were based solely on borrowed money. Investors mortgaged their plantations and enslaved laborers in return for bank shares, and the entirety of the bank's capital stock was based on these mortgages. But this practice still left the bank with no actual money to use for the issuance of banknotes or loans. Thus, in 1828, the state of Louisiana agreed to issue Louisiana state bonds to raise the requisite specie. Annual principal and interest payments by future mortgage debtors would pay the interest and then principal on these bonds, which were backed by the long-term mortgages on these same plantations and enslaved lives. The bank sold these state bonds to investors in the Northeast or overseas, who paid the bank in gold and silver. The bond purchasers had more confidence in the securities since they were guaranteed by the state and ultimately the taxpayers. This invested money then enabled the bank to begin issuing banknotes and extending loans on a fractional reserve basis. In response to this continued financing need, as well as the success of the CAPL model, the state chartered a second plantation bank in 1832, the Union Bank of Louisiana, capitalized at $8 million. And then a third in 1833, the Citizens Bank of Louisiana capitalized at $12 million. And these were the second and third largest banks in the country at this time, surpassed only by the Second Bank of the U.S. This model would also be copied elsewhere in the territory of Florida, in Arkansas, and in Mississippi. Stock subscriptions quickly poured into all of these Louisiana plantation banks, particularly from the sugar growing areas of the state. A typical contract with the Citizens Bank of Louisiana was this one here from 1836 between the bank and Bernard Marigny. Marigny mortgaged his sugar plantation in Plaquemine Parish along with 70 enslaved people listed by name, gender, and age in return for 490 shares of bank stock. These shares would give him access to a bank loan of up to $24,500. And this document is, if you can see it that closely, it's in French. Many of the bank's customers were Francophone, and many of the bank's early records were written in French as well as their early minute books. This expanding banking infrastructure, with its emphasis on large, long-term loans backed by landed and enslaved property, was critical to the development of the frontier South during the 1820s and 30s, and marked the pinnacle of the financialization of slavery in the United States. And these plantation banks were based on sophisticated financial concepts. While Southerners might not have had the jargon to describe these ideas fully, they had found a way to monetize their human property. Enslaved labor was, of course, first an input in production, generating profitable crops for a global market. With the closing of the international slave trade, enslaved people became a store of value for their owners, particularly given their positive rate of natural increase in North America. Slaveholders could not only buy and sell people as needed, like any other asset, but they could literally grow their wealth by breeding enslaved children. Yet this substantial investment in land and human property was not very liquid. It tied up capital and limited further investment in the region's economy. Frontier banks, particularly the plantation banks, solved this problem by allowing slaveholders to leverage their stored wealth in enslaved people. Slaveholders could now borrow against the market value of enslaved bodies in anticipation of repaying the debt, either from future profits or the appreciation in value of the enslaved life itself. Like a home equity loan, they could tap into the value of their human property while still enjoying the full advantage of their profitable labor, their natural increase, and their appreciating market value. Even more, enslaved people became abstract, fungible assets as part of bond instruments that could be bought and sold on the world's most modern financial exchanges. And unlike the slaveholders, traders of these instruments could remain willfully ignorant of the enslaved lives upon which their investments were based. The success of both the plantation banks and those traditional banks engaged in large, long-term lending secured by property depended on the market stability of the underlying assets, land, and enslaved people. Even with the memories of the Panic of 1819, no one was prepared for the possibility of the economy again collapsing. And just as leverage multiplies the wealth-producing effects of an asset in good economic times, it greatly exacerbates the losses in a downturn. During the panics of 1837 and 39, Southerners quickly found that they had over-leveraged their human property and needed to figure out how to disentangle these enslaved lives from the collapsing banks without destroying the system of slavery itself. Unlike the previous panic of 1819, when banks had only a limited relationship with the system of slavery, frontier banks in the 1830s had become so dependent on slavery that they faced two equally bad choices when the panic hit. Either, my lights are about to go out. Okay. Either foreclose on slaveholding customers and sell their plantations and enslave workers at a severe loss, or renegotiate more lenient terms with debtors in the hopes of a quick economic recovery, but risk the security of the bank itself. Even more so than during the early 1820s, Southern banks of the 1840s faced extended foreclosure lawsuits, greater instances of fraud, and other challenges related to long-term mortgage contracts. Foreclosures were not only complicated by the claims of multiple creditors and the confusing counterclaims of widows and heirs, but also newer difficulties such as the release of a debtor's obligations through federal bankruptcy proceedings and the flight of debtors with enslaved people to the Republic of Texas. And the bank still had to choose whether it was better to sell the property immediately, potentially at a great loss, or take ownership and managerial responsibility for a whole plantation with its enslaved workforce until market conditions improved. And when they did sell, the enslaved communities on these plantations were often devastated, as the people were sold in small lots to the highest bidder. This was particularly the case when the bank itself went into liquidation and was forced to sell off all of its assets, as was the case with the Bank of Alabama in the mid-1840s. So, just for one example, in 1842, the widow Louisa Owen had mortgaged her land and approximately 30 enslaved people to the Mobile branch of the Bank of Alabama to secure a debt of just over $28,000, which would be about just under $1 million today, roughly. She promised to repay the mortgage in 5 annual payments between March 1843 and March 1847. When she failed to pay these installments, the bank, which now was in active liquidation, it had failed, put the property into foreclosure. And in September 1845, it took over put it in foreclosure in September. It took another 3 years, though, for them to divide and sell these 30 enslaved people. Now, initially, the bank decided to hire out the slaves among 10 local slaveholders, while they were all simultaneously advertised for sale. The bank received about $18,000 for their hiring, but they had all these expenses they had to pay for insurance, for taxes, for hiring fees, for advertising, jail fees, doctor's bill, clothing, shoes. So this was, a complicated transaction to have these slaves and be have to manage them and manage the hiring process for them. The bank then gradually sold off these enslaved individuals. So one enslaved holder purchased 19-year-old Selena and her child for $700 in April. In May, another buyer acquired 18-year-old Barbary for $550. In July, 28-year-old John sold for $725. Another slaveholder obtained 38-year-old Hackey for $500, and a third acquired 38-year-old Sylvester, 40-year-old Foley, and 40-year-old Mac for the combined price of $1,500. In October, 24-year-old Bob Wiggins was purchased for $625, while the following month another slaveholder acquired 12-year-old Romero for $425. Also in November, a local minister deposited $500 for the purchase of the family of 30-year-old Fanny and her 4 children, Isabella, Thomas, Margaret, and Virginia, but changed his mind before finishing the sale. A local doctor paid the balance of $900 for the family in February and received a bill of sale. In January of 1849, the bank advertised for sale the family of 42-year-old Robert, his 35-year-old wife Fanny, and their children, 16-year-old Austin, 12-year-old Sarah, and 10-year-old Washington, but ended up selling them at a private sale for $2,500. Similarly, 35-year-old Ben was advertised for auction, but sold that same day at a private sale to another slaveholder for $500. Now, absent the liquidation proceedings, the bank might have extended Owen more time to pay her debts, keeping this enslaved community intact. But the bank's closure forced the sale and dispersal of these individuals across at least 10 slaveholders. And although in this case, these sales tried to keep the nuclear families intact, it was very common for the sales to break up the families themselves. Yet, especially in the case of the largest debtors, the banks often treated them as too big to fail, repeatedly renegotiating loan contracts to avoid, at almost any cost, the seizure and sale of land and human property in the midst of the downturn. Having invested so heavily in plantations and enslaved lives during the 1830s, most banks chose to prop up the system of slavery rather than to oversee its systematic collapse. By serving as a financial safety net for slaveholders during the Depression, frontier banks helped lay the foundation of the Southern economic boom during the 1850s. The willingness of banks to embrace long-term mortgages on land and human property, and their leniency toward many delinquent slaveholders during the Depression itself, ultimately resulted in the failure of a large percentage of banks, particularly in the frontier South. In effect, many frontier banks sacrificed themselves at the altar of the slave system. Slavery would survive, but at the expense of the banks. Now, although banks had played a critical role in the expansion of the slave economy during the 1820s and 30s and had successfully helped to navigate indebted slaveholders through the panics, they had been merely a means to achieve this financial end. Even as the slave economy triumphed and cotton became king during the 1840s and 1850s, frontier legislatures rejected the continued dominance of banks in the financialization of slavery. But by the 1840s and 1850s, the innovative financialization of slavery by formal banking institutions was no longer necessary. By facilitating rapid expansion in the southern frontier during the 1820s and 1830s, and then providing stability for slaveholders during the Depression, frontier banks had successfully entrenched plantation slavery in the Southwest, paving the way for the region's economic boom period by mid-century. Only the most capital-intensive sugar planters remained dependent on state-chartered commercial banks. When frontier legislatures reconsidered the role of banks by the 1850s, they were no longer seeking novel financial solutions for an emergent economy and could instead return to the more conservative structures of traditional banks. As legislatures aggressively pushed back against bank financing of slavery, slaveholders were forced to pursue other methods of financial support. Private bankers, out-of-state bankers, and merchants attempted to fill this void, but most lacked the economic resources available to incorporated institutions for financing large-scale endeavors. The most successful of these newcomers would develop into some of the nation's investment banks. But that's a story for another book. Several Deep South states would eventually reconsider the wisdom of their anti-banking policies during the 1850s. Yet in doing so, they would return to the traditionally conservative banking practices of the North and the Eastern Seaboard, explicitly rejecting the innovative banking practices that had driven Southern frontier development in the 1830s. These new banks were less accommodating to the financial needs of slaveholders and the slave system. Banks on the southern frontier had fulfilled a specific need during a crucial moment in the expansion of the slave system, and then they retreated to the background. Thank you.
All right. Well, thank you very much, Sharon, for that fascinating conversation. I again encourage our audience to put questions in the Q&A, and we'll see these and ask Sharon to answer them. But in the meantime, I'm going to begin by posing a few questions of my own to get the discussion started. So I was going to start small. That is, you mentioned during the talk, and you showed us an example of the notarial records, and I assume this was from Louisiana, and it comes from the French legal system that persisted in Louisiana into its incorporation in the United States. And I wondered if you wanted to tell us a little bit about these notarial records and the part they played in the making of your book.
Yeah, no, that's a great question. So the notarial records were so key to finding who was actually doing the mortgaging. And actually, it's not just the first notarial records I encountered were actually in Georgia. And I got really excited when I started
Hmm.
seeing those. Um, and in Georgia, they're centrally located in the Georgia State Archives, which is kind of nice. So you can go like one-stop shopping. And but they are looking for needles in a haystack, so you don't know what you're going to find. Um, The Louisiana ones are, or the New Orleans ones are still, you are still in bound books in the land office in New Orleans. So I would be going there, and it's the same place that lawyers were going to do deed research on any property in New Orleans. It's the same exact records. And bring out these books, and you're looking at the originals. So they're not microfilm, which is kind of exciting just to see the originals. And they are a little better indexed, so it wasn't quite the needle in the haystack that I was looking at in places like Georgia, or North Carolina is another place, Kentucky, another place where I was able to look at their notarial records. But so it's not just because of Louisiana's legal system. These types of records were kept in all the states, and just to varying degrees that they still exist today. But certainly the ones that were most valuable to me were in Louisiana. Alabama, most of their most valuable records were actually the closure records for that state bank. Since it was the state bank, as they were closing, they had all this record dump into the archives, and so that was actually really useful to see how the bank closed and how that affected all this enslaved property that they owned or had as mortgage collateral.
I'm going to ask one more question, and then the audience questions are starting to come in as well. When you described the rise of the plantation banks in the later 1820s and the way they were essentially basing them on mortgages of land or slaves, it brought to my mind, as a historian of colonial America, the experiments in land banks that had been made, especially in the 18th century, and the driving force for those was often the fact that the money supply was so limited in colonial America that by essentially pledging the value of their land and then issuing money based on those, these land banks were thought to be able to expand the circulation of currency. And I'm just curious whether the origins of the plantation banks, the people who were starting them were aware of this past, or they had any understanding of what they were doing as also generating a form of currency.
Yeah, that's a great question. Um, the land banks are technically not banks. We call them land banks, and
Right,
they're called
right.
land banks. So they're not actually functioning as a bank does in expanding the money supply, and so they function slightly differently. I have no evidence that the people who were doing this um, had a recollection of that. There's some references that they make to property banks in the uh, closer to the revolutionary period. But even those are kind of sketchy what they're talking about. And they're really talking about something a little different. So it's not clear that they actually are making that connection. I mentioned this in the book that there is obviously a precedent, even if it's not a formal bank, a precedent to these plantation banks, but it's not clear that they're drawing on that model. I don't see any evidence that they said, "Oh, yeah, we did this once before in North Carolina. We should do this again." So,
Okay. Okay, good. Well, look, we have great questions coming in. I have a few more that I might come back to later. But the first one from Mitchell Snay is this. Do your findings on southwestern state banks help explain why the states of the Upper South seceded later than those of the Deep South? Is there a financial story behind the secession sequence?
I think there could be a financial story, but I don't think it necessarily relates to my banks in particular. I think that a lot of financial historians would say the Upper South had much closer trade connections with the North, which made it more difficult for them to sever those bonds, even though certainly Louisiana has lots of trade connections with New York with the cotton and the sugar trade. So I think that's an imperfect thing to say. But that's a really interesting question if that relates too much to secession. There's a lot of um, space and time between what the 1830s when I really 1830s and 40s when I end, and the 20 years later when the war erupts. So I'm not sure that I would do a whole lot of causation between the timing of secession and the banking system. But I do think the trading environment probably has a lot more to do with it.
Okay. Rachel asks about private lending groups outside of state banks and mentions having wealthy slaveholding ancestors who were on several bank boards in Columbus, Georgia, and involved in a financial lending company, and wonders. Wait, also, they did a lot of business among each other rather than using the bank.
Yes.
Basically, a question about private lending groups.
Yeah, so to her point, I mean the intersections here are widespread that, you had lots of planters who were also politicians, who were also on the bank boards and everything, but you also do have these private groups. So I made it very clear. This book was long enough on its own without adding all the other possible financiers in here. And one of the reasons I wanted to talk about state banks was because it does have that state imprimatur on them, that this is a state sanction for what they're doing. But there are lots of private lenders who are also operating, doing many of the same things, usually at a smaller scale, though. It's harder, it's hard to do these large scale loans. Most people don't have the funds for that. Now, I do have a section of the book that gets into great detail on Brown Brothers, who come down and um, do get involved in plantations in Louisiana. And I only deal with them because they are taking over loans from from the Citizens Bank. And so there's interactions with my banks. And so there are definitely, like I said, people who are going to develop into investment banking firms. Um, in the aftermath, when most of these southern banks, especially in the deep south, become anti-bank after the panic, you do have many of these merchant kind of mechanisms coming up. I've toyed with my next project being about these private banks in the 1840s and 50s. But talk about needles in a haystack. This may be a project that takes me 30 or 40 years to accomplish, because they are much more difficult to locate. But yes, they're operating alongside the banks. Um, they're operating before the banks come along, they're operating alongside the banks, they're operating after the banks are gone, but they just don't have the amount of capital. I mean, a $12 million capitalization for the Citizens Bank is hard to match with just private merchants, but they do try to fill in. So great
Sure.
question.
Yeah, good. Well, we have a couple of questions that focus on, uh, for better or worse, the human dimension of the collateralization of enslaved people. Julia talks about it being chilling to hear an account of how humans were treated as collateral, and asks you, Sharon, how you dealt with writing about this as a series of transactions, and wonders whether any of the 1840s purchases were an attempt to free or at least alleviate the lives of those being sold. And Nell Painter asks whether the human characteristics of people as collateral bleed into the financial records at all, the complications of people as assets. And a third question along these lines, from Camille, as to how illness and death fit into the equation of enslaved people as collateral.
Yeah, oh my God, those are all such great questions. This was really the hardest part of the project for me, was how do I, because the process of financialization is a process of erasure, about making these just fungible assets that you can move around. And how do I not recreate that violence in my book? And so how to do that. I mean, one way was I tried as much as possible to talk about individuals by name when I had their names, um, and to downplay the individual slaveholders as much as possible. To who I humanized, I tried to humanize the people themselves, the enslaved people themselves, more than the slaveholders. I I kind of had a little ritual penance that I would do, um, which was I tried to keep an active list of whenever I came across the enslaved people, I would, type out their names and ages every time, just so I was like, okay, I'm acknowledging you, even if I'm not going to be necessarily able to name you everyone. At least I'm kind of doing a ritual penance here. Um, but it was hard. That part of it was definitely hard. I really tried, and in when I had tracing these mortgages over decades, I tried to trace families and trace people who, stayed present in those records, and you could trace their lives and see what was going on in their lives. I did not see a whole lot of effort at freeing these slaves ever. In my first book on insurance, I had a whole chapter on insuring enslaved people, and there were some remarkable stories of people using life insurance as a backdoor mechanism of emancipating people. So I was certainly like attuned to, is any of this going on? And I didn't see any of that, unfortunately. It didn't seem to be efforts to do that. Um, there was, at times it bled in a little bit about, especially, so for one thing, the obviously people age, they lose value as they age, they die, they get sick. You do see in the descriptions, sometimes it was just name, age, and sex, but sometimes they would actually have descriptions of the people, and that could be interesting. Sometimes it was a job. But other times it was interesting. Sometimes it was racial descriptions, but sometimes it was also, um, you know, their temperament, that someone's more likely to run away, or someone is, a good house slave or has been loyal or something. So you sometimes see those types of things bleeding in. Um, the mortgages required the value of the property to be more than twice what the loan was going to be. And so that kind of compensated a little for if value was reduced over time. But you did see, and this was kind of an interesting thing as well. This slowed down sales. So if you have your property, my lights are going to go off again. If you have your property mortgaged to a bank, you can't then sell that property while it's under mortgage. And so that kind of slowed things down a little bit. And slaveholders would have to appeal to the bank to release certain slaves from mortgage, and often would have to replace with other slaves. And so in those things, you would sometimes hear stories about, well, why are you releasing them from the bank mortgage? I want to sell them because they're not as valuable to me anymore. They've become less useful, but I'm going to replace them with this slave in the mortgage. And so you do see these kinds of stories cropping up. Thankfully, so I got to know personally, um, some of the lawyers who were writing these notarial records, some of the notaries, because you're reading these people, and you kind of, and some of them were quite chatty. I think they were paid by the word, and so some of them would go into great detail about where the slaves were obtained from and what were the history on those. And I just loved those, when it wasn't just a list of names and ages, but where they came from, where they were purchased from, what was their backstory. And so some of that, and whenever I could, I tried to then put that into the book as much as possible to really see what was going on with those individuals. But it was, unfortunately, the nature of my sources made that painfully limited. So I did as much as I could, but I certainly still felt like, in the end, this was not about the people as much as I would have liked it to be in a different world.
Right. I'm going to follow up on a comment you made, which is right on point here. You mentioned slaves being defined as immovable property and said that was a topic for later. Well, it's later now. And as I understand it, this trend goes back to the 18th century. Claire Priest's book
Yep.
uh, talks about how the parliamentary legislation of the 1730s essentially said that, things are different in America, and their, land is not the single most valuable thing the way it is in England. And for most of plantation America, land without labor was no good, right? And so
Right.
the definition of enslaved persons became essentially equivalent to that of real estate for the sake of, what can be claimed in the payment of debts and that sort of thing. Is that where that comes from, or is there?
Yeah, no, absolutely. And
Okay.
and this is actually where the legal situation in Louisiana is a little different from the rest of the South. But it actually changes over time. So in the rest of the South, they talk about real estate and personal estate.
Hmm.
Whereas in Louisiana, it's movable and immovable property. And they're not quite equivalent to each other as ideas. But how you define slaves, whether you define them as real estate or personal property, affects inheritance. It affects the rights of widows to their dowry, to how they're able to claim property, and all this comes out in I was not a legal historian before I started this project. I feel like I've become one now, but the legal records, this really comes out because all these widows will start saying, well, my husband mortgaged the slaves, but he really didn't have a right to, because that's not how they're defined in this state. And the status would change over time. Louisiana, where much of my story takes place, though they do define it as very clearly as their immovable property because of, as Claire Priest talks about, this necessity of tying the enslaved people to the land. If the eldest son inherits the land, but all of the enslaved property gets dispersed among the other siblings, what good is it to them? So
Right.
tying it to the land is what makes the most sense from, and also from for the purposes of British debtors, etc. So yeah, absolutely.
Right. Okay, we have a bunch of good questions that turn back to banking. Um, One on how the abolition of slavery affected the plantation banks. Another particular to Texas, which you mentioned, which uh, apparently Sean Page says Texas outlawed banks from 1835 to the 1860s. So how did Texas fit into the development of its cotton economy? James Dupee asks if banks or lenders saw opportunities for speculative lending, similar to what we might call predatory lending, when the debtor actually, when the bank actually hoped the debtor would fail to pay and secure the capital. And last one, and you can choose among these. Andy Shockett, in addition to heaping praise on your book, asks about those banks that wrote loans that were inconsistent with the charter, and what's going
Mhm.
on there. What was the bank director doing?
Yeah. Oh, wow. All great questions. I'll try to get hit all of them quickly. So, abolition of slavery. So most of the plantation banks had were gone by this point. The two banks that were really surviving, one's a plantation bank, one's not, are the Canal Bank of New Orleans, Canal and Banking Company, and the Citizens Bank of New Orleans, which fails, operates as a private bank for about a decade, and then gets a new charter again and continues. Um, Both of those, so interestingly, Louisiana falls very early in the war. Both of those continue operation, and they eventually become part of J.P. Morgan. And so J.P. Morgan technically owns those assets, but it's not until the 1920s that they do acquire them. So by that point, they probably had no clue what they were involved in initially and what their original loans are. But so those banks hobble along, even though most of the plantation banks have died by then. Yes, Texas was notoriously, because Texas starts out right around the panic. It's notoriously anti-banking. So Texas largely relies on private banks and banks out of state banks to for its financing needs. But Texas is also where all those debtors are fleeing. And so I have some great stories of people fleeing their debts and then reestablishing themselves in Texas and becoming some of Texas's leading citizens as delinquent debtors. But yes, they have to rely on other sources of financing. They can't do it through a banking system. Um, I don't have, for the most part, my banks are not speculative or predatory, mostly because the same people who are running the banks are the same people who are the debtors. Like they're all related to each other, or if they're not the debtors themselves, they're their cousins and best friends and neighbors. So they're not actually trying to be predatory here. They're just all trying to make money as much as they can. And so I don't see that aspect happening. I mean, there's certainly some speculation happening, but I don't think it's in a predatory manner. Um, Andrew, writing loans that are inconsistent with your charter, they get very crafty in interpreting the wording of the charter. And what the charter says they can and cannot do. And so they become get into this circular logic about what's allowed, and other times they just completely defy it and hope no one notices. And you know, the for the most part, and again, the politicians are also the same people here. We're talking about a very small bunch of elites who are doing all of this nonsense. So yeah, they push the boundaries as far as they can. They do sometimes clearly cross over into illegal areas, and then that's when they start, well, we need to charter banks with different rules because we can't we've pushed the limits here and we've pushed it further than we can go, and it's not no, still not enough. And that's where they start going in other ways. But they definitely get very legalistic about, you know, what is allowed and what's not. And there's court cases that spin over whether or not what they're doing is actually illegal or not. So
Okay. We have only a few minutes left. I had a question that I wanted to speculate about a little bit, and you've been sort of touching on it, but I'm going to ask it directly, and that is how you think your work shapes how we now think about questions of let's say complicity in slavery, right? I mean, it's one thing as one of the persons writing in with a question, you know, talked about having ancestors who were wealthy slave owners and all, but you know, by showing how the great expansion of slavery in the Cotton Kingdom was, you know, backed and supported by this banking system, which was chartered by states and which, in a sense, by securitizing enslaved people, spread the ownership of them out to all kinds of people, many of whom perhaps didn't know what it was backing the securities they own. I guess the question is, how does it shape how you think about the question of sort of complicity in slavery, both then and now?
yeah, that's actually my epilogue. I kind of grapple with that. Because a lot of times, both in my life insurance work and with the banking work, you know, people ask questions like, well, you know, can we figure out who was involved in this and hold this bank accountable now? And the problem with that is most of these institutions no longer exist. Um, but you know, to your point, where I come down is, you know, these were not important institutions for an individual plantation or an individual location. These were essential to the American economy and the development of the American economy. I mean, my ancestors arrived after the Civil War. Um, but I am still a beneficiary of all of this economic prosperity that came out of this time period. So I've kind of come down as, you know, it's all well and good to uncover the institutions that were involved and to point them out. But in the end, I think we are all beneficiaries, so we are all complicit. And it doesn't mean that we were willingly complicit in any way or that we're all, but that we have to take ownership of all of this, and we can't just say that was a Southern problem, or that was that particular bank's, or JP Morgan now accidentally bought a former plantation bank, and so now they're responsible for the lives of, 100,000 slaves that were mortgaged by that bank. That I think that's the wrong way to think about it. So I come down on complicity as we're all complicit in this. So some there may be more complicity and less complicity, but in the end, it's all complicity.
Yeah. Okay. Well, we have now hit the hour of 8 o'clock. So first of all, I want to thank you, Sharon, for this fascinating program, and encourage everyone to follow the links in the chat to go out and get a copy of Sharon's book. And then close by saying thank you to our audience. Thank you for your excellent questions. And allow me to invite you to join us for our next virtual program at the AAS, which is on Tuesday, October 7th at 7 p.m. for Harold Holzer, who will be speaking on his new book, Brought Forth on This Continent, Abraham Lincoln and American Immigration. These and many other programs are listed on our website at AAS, where you can register in advance, and all programs are free of charge. Thanks again, and have a good evening, everyone.